This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Well, Eric, the massive correction in the gold and silver markets doesn't appear to be quite finished yet, as both gold and silver sold off throughout the day Friday to close the week just above their lows placed a month ago back on April 15th. Silver traded as low as $22.09 Friday and gold as low as $13.54. And with the sell-off into the access market close, a retest of the April lows is now likely, possibly as soon as Sunday night's Globex session. Our regular listeners will recall that back on our April 12th show, we warned that a drop to 22 was dead ahead in silver, and that target was met over the next two trading sessions. So with today, Friday's action late in the session, a break of support at 22 is entirely possible, really Sunday night into Monday. We could easily see a silver test $20 with the possibility of a spike capitulation low, even potentially briefly breaking that to the downside, running towards 18 or 19, which would essentially retrace the entire 2011 bull move from $18 to $50 and flush out whatever few remaining weak hands remain. So, Eric, this correction has been almost visceral, and I'm sure many of our listeners and readers could attest to that as well, and has left even some of the most seasoned gold and silver bulls, even myself included, questioning whether we could possibly have everything wrong. But I think if you're honest, if you're honest with yourself, remove your emotions from the situation and evaluate the global and the U.S. economy from a fundamental perspective, the fundamentals haven't changed one iota, and the fundamentals are stronger today than ever.
Yeah, with the possible exception of this whole discussion about the quantitative easing effort in the United States coming to a premature end. But when you look at that from a broader perspective, in the last 3 years, the Federal Reserve has been taking down 50% of the Treasury issuance for our bonds, and in the last quarter, it was somewhere in the neighborhood of 75%, and there's not enough demand to support the bond issuance that is going on, and therefore too few people are asking the obvious question: who will buy our bonds if the Federal Reserve stops backing up the truck when it comes to the long end of the bond market? And the same can be said actually with mortgage-backed securities and how that's helping the banking system basically flush 10 cents on the dollar or 20 cents on the dollar paper down the toilet in exchange for the Fed making them whole. These kind of things have direct ramifications to the long-term interest rate credit system in the United States, such that we could, without this support, see a reversion to the long-term averages of 6, 7, 8% or so on the long end. And if that were to happen with our leveraged economy now, things would just begin to fall apart in record time. So this whole effort by the Federal Reserve and the Treasury and the business press in cahoots with those policymakers to try to spin this global economic recovery that's inching along, led by the United States, as the people claim, it's illusionary in many respects because it's being supported by the warehousing of all this bad paper. And even though we don't see money supply shooting higher and inflation expectations going higher, the bottom line is that all of this stuff is required to continue to have this fake economic recovery support asset prices. This is not open for debate. If the Fed was not buying all of this paper, we'd have interest rates that were much higher than where they are now. And you could kiss any notion of an economic recovery goodbye if that were the case. When it comes to the fundamentals, there really hasn't been that much of a change, other than the fact that sentiment, which is certainly part of the fundamental backdrop, has been obliterated in North America. And we'll probably later on talk about all the offtake that's going on in Asia and other places in the world when it comes to physical demand vis-a-vis this paper selling. But when it comes to North American gold and silver investors, there really aren't that many people who really believe in this stuff. And you and I were talking off air about how the market has certainly calmed down and premiums have contracted, and there is less demand and enthusiasm for buying the dips, as it were, in North American markets. But it's not the case going on around the world, and we'll speak to that later. Maybe you want to quantify some of what you're seeing as far as coin demand and the retail chain.
Yeah, sure, Eric. But before we look at the silver supply issue, just wanted to touch on a couple of other issues for the fundamentals, especially on the U.S. side. You touched on the Federal Reserve and taking down 50% of the Treasury issuance, and that's exactly right. And also the unemployment situation in the U.S. U.S. population employment ratio hasn't budged at all from 58% since it bottomed in 2008. So for 5 years, and the actual percentage of Americans with full-time work hasn't even increased a measly 1% off the lows.
And there's also all the various ways that they massage the data further. I mean, you have a gigantic increase in the student population. You have doubling of people who are on disabilities within the last 4 years or so. You have the increase in the duration that people can remain on the unemployment rolls, and the fact that after 24 months, if you're no longer looking for work, that you're considered just a vanished statistic. You no longer exist. All told, we're talking like 12, 13 million people in all of those various categories that are now taken out of the picture, and that's how that employment ratio has contracted so much, and this whole myth about how we've had this recovery in the job space is just, it's bizarre. But
right. So we haven't seen any recovery at all in employment in the U.S. anyways. The labor force participation rate is plunging and setting multi-decade lows. And we also have the U.S. Hitting its debt limit again over the weekend, meaning a roughly 3-month countdown begins until the Treasury Department, while they raid various other funds until the government totally defaults. Come sometime in August when the debt limit... The real debt limit is reached and it's raised again. The official debt limit is raised again at the last minute, sometime probably mid-August, early to mid-August. We're going to be raising the debt limit to somewhere around 19 to 20 trillion most likely. So we have that. And again, remember, we're only 2 months post the Cypriot depositor bail-in March, and the discovery really by global financial markets and a lot of that was, a couple of the stories were broken here in Silver Doctors, that the Bank of Canada, Bank of England, the Fed have all made it clear that really when the next banking crisis hits, whenever that might be, whether it's 3 months, 6 months, 5 years down the road, depositors are going to be bailing in the likes of Bank of America, JP Morgan, Goldman, etc. So really the way I see it, the fundamentals that propelled silver from $4 to $50 and gold from $270, $280 to $1,900 remain intact. And the latest correction really has allowed those who entered the market late and missed the entire move from 18 to 50 in silver a second chance, if you will, to preserve their wealth with physical gold or silver ahead of what's coming for the Western banking system. It's really the way I see it.
And for new people to actually establish positions at a favorable price, and they would obviously have to be against all of the messaging that we're getting from the mainstream media and the extreme nature of this big correction. But as far as the fundamentals go, the markets are not speaking to a beginning of a bear market in gold. We have volume on the rise in terms of total offtake in Asia when it comes to at least 2 ounces being bought in gold for every ounce that's being sold out of GLD and all the various other ETFs. And even if you look at things like how the business press treats George Soros' moves, it's quite telling. He's been reported to have sold his GLD position, the Spiders Trust, which is the largest gold ETF, and it was reported that he had sold about 12% or so compared to the December 31st holdings that his hedge funds held. But in actuality, I went into the Securities and Exchange Commission's Edgar database today just to do some fact-checking on it, and I was astounded to find that, in fact, Soros has, believe it or not, folks, increased his holdings in relation to the gold space, but you're not going to hear that in the mainstream media. Soros increased his GDX holdings by about 75% between December 31st and March 31st, which is the period which is being reported this week when it comes to the 13F filings that all of these large hedge fund folks have to report to the Securities and Exchange Commission. So anyway, GDX, which is the ETF for standard mining shares that has all of the large miners in it, like Barrick and Newmont and many of the other large players in the space, was increased by 75%, and his exposure to the GDXJ, which tracks about 70 some odd smaller companies, in gold and silver actually, but primarily gold, while he did reduce the net exposure, or I should say the exposure of shares directly by about 40%, he actually more than offset that by going even more aggressively in a leveraged position of call positions that represented an increase of 52% for the share exposure. So, he put on these calls that more than offset his reduction of the position in GDXJ. So net, here you have Soros fund management making a very leveraged bet to the increase in the price of gold, which mining shares represent. And all the while, if you go to Google News right now and type in Soros gold, the only stories you're going to see are discussing how Soros is a bear and he's got it right and everybody needs to sell all their gold because the bull market has begun. And Soros recognized this back in the first quarter, and you should be so smart as to follow his moves. Well, the bottom line is that actually is 100% inaccurate. And hardly anybody in the press that I can tell has reported this fact. So it's just another nice little quantitative, irrefutable example of how the media, the business media, primarily in North America but in Europe as well, are spinning this to serve the interests of the advertisers and, in fact, in many cases, direct owners of the financial press. They are, in fact, business interests. So it's no surprise to see this much effort being put on the desire to make everyone think that the bull market is over and all these smart investors are abdicating their positions when, in fact, we don't even know to what extent GLD holdings are, in fact, redeemed strictly for cash. I mean, theoretically, Soros could, in fact, have transferred 100% of his GLD holdings into physical bullion and warehoused it outside of the COMEX system in a private vault and not have to report that to the Securities and Exchange 13F filing, and nobody would know any better. I mean, it's ridiculous how the media is trumpeting this whole meme about the bull market being over when you can turn to Asia and see offtake there and physical demand that is well in excess of the aggregate amount of ounces that are represented by the sale of all of these paper instruments and the COMEX and the GLD, et cetera, et cetera. Turning all the way back to where we started in this conversation, we're talking about price points and whatnot. I mean, even if we look at silver has had a couple of days in the last 2 weeks where it's had pretty significant relative strength compared to the pounding that's been going on with gold. Certainly there have been other times when silver has taken greater heat, but even as early as or as recent as yesterday, silver on an end of day basis on COMEX actually closed up, whereas gold was down. So I think this does speak to the fact that there is some rotation going on where J.P. Morgan periodically will be covering some of their shorts, and it seems like the COT, actually, the Commitment of Traders report, speaks to this. So we don't have data for anything up through the days after this past Tuesday when it comes to the Commitment of Traders report, but that'll be something to look at next week and see if, in fact, through all of this turmoil and in the days that are going to follow with Monday and Tuesday's trading, if we, in fact, see some stabilization and some short covering by J.P. Morgan and other commercials that are going short in the silver market and managing things, because we've certainly seen a general theme of rotation where the hedge funds and managed money and momentum players have been taking on the aggressive role of shorting, where it's also visible that there's been additional long positions and lessening of shorting, certainly with respect to gold, but to some extent even in silver. Like I've been saying since mid-April, if you look at the whole context of silver's trading over the last 2 years, and then some, and then how J.P. Morgan will be managing its average net position vis-a-vis the price of silver, I mean, there's really a good case to be made that they're probably net profitable, that they don't have any particular need, at least from the perspective of managing their book, to push silver below 22. Time will tell if this double bottom holds, but at least with respect to silver, there is some percolating going on. I mean, in today's trading, we also saw copper trade reasonably well, despite the fact that a lot of people are making the thesis that we're in a deflationary period and that's what's being priced in with gold and silver. performance of oil and other commodities have periodically supported that thesis as well too. So we'll see. It's going to be an interesting trading week. But yeah, I think to one way or another, next week will be the litmus test as to what happens for the summer, and that, in fact, if they're able to crash gold below 1,300 and silver below 22, that we're just going to have to suck it up and deal with lower prices on the paper markets, because that momentum is going to be hard to counteract. There's just not enough interest in the propagandized financial space among the institutional players that make up the North American and European money flipping markets.
And getting back to the physical side and the wholesale level here in the U.S., I know listeners are looking for an update. Seems that sales have dipped a little bit in the U.S. over the last couple of weeks. Premiums continue to drop a little bit, especially in the mint products of the Silver Eagles and the Silver Maples. They're not dipping quite as much in the generic rounds, at least from a wholesale supply side. But and as far as our sales as well at SD Bullion, they're definitely off quite a bit from, say, mid-April through May. So really, it's interesting. It seems we seem to have had a pretty massive shift in sentiment, really peaking this week, as it seems like a lot of even the long-term bulls have been shaken to the core. We saw last month's dip to 22 in silver and 13.20 in gold. Really, right away, it was met with a buying frenzy by the retail public here in the U.S. Many of those same investors now are throwing in the towel and stating the bull market has ended. So one point I wanted to make, Eric, is that when you look at gold, especially gold's monthly chart, it's just now touching its long-term bull market uptrend line, which, if you look over really the duration of the bull market, has really been an amazing opportunity to enter or add to gold positions. The 2 or 3 times it has touched its long-term uptrend line on the monthly chart, it's made extremely strong moves off of those lows. So really, as we look to the week ahead, Eric, there's a strong possibility that both gold and silver will retest their April lows this week, possibly as soon as the Sunday night Globex session. But for our long-term perspective, like Peter Schiff said about gold perhaps a couple of months too early, the gold and silver bull market is dead, but long live the gold and silver bull market. So it'll be an interesting week ahead, and as Eric said, it really could be the litmus test for the summers. For the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets.
SD Bullion.